Hey everybody, this is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, June 6th, 2026. Hey, how you doing? I hope everybody's doing okay after the market's action on Friday. I hope you're staying safe, adhering to your stops. Boy, that was some kind of day yesterday. Unbelievable. Really unbelievable. Yeah, it really kind of a tough trading week. Had some good trades, had some losing trades, obviously. But the big part about trading is that you don't always have winners, and you have to learn to deal with losers and manage losers and take your stops. And this week um, was part of it. Was part of it. So I'm going to show you all this. So thanks for coming to the podcast. I hope you're going to find it helpful. Um, I think I have some good things for you today as far as the trades that I have and how I managed them last week, and then some potential trades for next week. But the format, first of all, is we're going to run the U.S. legal disclaimer. Secondly, going to come back. We're going to take a look at all the trades I made last week. We're going to talk about when I entered the trade, why I entered the trade, what the setup was, what the confluence of the signals were of why I entered, how I position size correctly based upon volatility, how I place my emergency stop, how I place my end of bar stop, how I take partial profits if the market moves my way on a daily basis, what I do when I get to trailing stop level, and then ultimately how I exit the trade. So I have a bunch of trades, still have a bunch that are open, still have a bunch that I got stopped out of, but I'll show you all of that. After that, we're going to talk a little bit about trader psychology. Boy, this is a perfect week for the psychology because this week hurt a lot of people. Friday hurt a lot of people. So, um, it's easy to follow your rules when things are going well, but when things fall apart, it's more important to follow your rules. And unfortunately, that's when a lot of people stop following the rules. So spend a little time on trader psychology. It's always helpful for me to teach. Hope it's helpful for you. Hope you'll learn something, hear something, internalize it, and that will help your trading. And then lastly, last night I went down through all of the symbols in my master watch list, and I have identified some potential trades for next week that are getting close to some significant confluence of support for the longs. And so they're not there yet. If they were, I probably would have already taken the trade. But I think I have 9 different tickers next week that I'm looking for, that I'm going to be tracking, that I'm going to wait for rejections in certain areas. And if they do, I'll potentially take the trade. So hopefully that will be helpful for you, give you an idea of how I look at my setups on the weekend and what I'm looking for the next week. So if you find anything helpful in the podcast today, I really would appreciate it if you could hit the thumbs up button. It really helps the channel out a lot. And with that, let's get started. I'll run the U.S. legal disclaimer and get that out of the way, and then we'll get going. So hang tight.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right, thanks for holding through that with me, and let's get started. So, I use a variety of levels that are key in my trading. First one would be an order block. Majority of my trades involve an order block, also major moving averages, RSI levels, double bottom MACD divergences, and V1, V2 entry signals. So as we go through these trades here, I will show you how, and I combine a lot of these together. So on this particular trade, I will show you exactly what I did. And let's get started. So this is CCL. This has been a really good trade. I did enter CCL here on the 19th of May, right near the bottom here at 23.88. You can see I entered this trade when it was inside of this green box. This green box is what is called an order block, and they're a key component of my trading. So in order to have an order block appear, I need to have four things need to happen. The first is I need to start out with a swing low. And if you can see back here on the 24th, this is a swing low. A swing low is simply a low that has a higher low to the left and a higher low to the right. So we have swing low. After the swing low, the next thing I need is a swing high. Swing high is opposite. Swing high has a lower high to the left and a lower high to the right. So now you can see we have a swing low, we have a swing high. The next thing I need, the third thing I need, is another swing low that's lower than the first swing low. And here's another swing low. Higher low to the left, higher low to the right, and this swing low is lower than the first swing low. So swing low, swing high, lower swing low. As soon as we have that lower swing low in place, I refer back to that first swing high. And in the future, if the price does then, after the lower swing low, does go up and break above that first swing high, that is called a market structure change. And market structure change, the way that I view it, is that now we are in an uptrend and I want to be looking to buy dips. So swing low, swing high, lower swing low, market structure change. As soon as the market structure change happens, now I can define my order block. Order block, the way that I do it. Now, people trade order blocks all sorts of different ways. And I've heard people say, oh, that's not how I learned order blocks. That's fine. It's the same principle, but this is just how I do it. I want to make it simple and it works really well for me. So when we break above that first swing high, then I define the lowest closing bar prior to market structure change is my order block. So I highlight that. I highlight the high and the low of that box or of that bar, and I bring this into the future. Now, swing low, swing high, lower swing low, market structure change. You can see it did pull back to the green box before it took off. But the point I always like to make here is look at CCL here on the 17th, up near $30. Well, when it's $30, can I look back at this order block and say, well, that was smart money buying at that area? And clearly, in hindsight, smart money was buying that area. So order blocks to me are really smart money. So swing low, swing high, lower swing low, market structure change. When this comes moving all the way up here, yes, I can look back and say, yeah, that was smart money. So the idea is I want to then wait. I don't buy the breakout. I wait for a pullback back to the smart money area. Now, just because it was smart money over here doesn't necessarily mean in the future, if it comes back to it, is also going to be smart money. Things can change, right? But in my 30 years plus of trading, more times than not, the previous smart money is smart money. Now we have to have rules, stops, all that kind of stuff in case we're wrong, because there's certainly no guarantee. So there's a lot of different ways to enter order blocks. You can take a rejection of the high of the order block. You can take a rejection of the low of the order block like I did. I also like when moving averages are inside of the order block, so I can look for a rejection of that key moving inside the order block, giving me a very well-defined stop. But in this particular case, I did enter CCL here at 23.88 because we rejected the bottom of the order block. In other words, we went below the low of the order block during the day, and then by the end of the day, we closed back in it. That is called a rejection. The way that I look at it, it's called a rejection of the bottom of the order block. So that is why I entered on the 19th at 23.88. So the question is, and probably the most important thing in trading is, okay, I have an entry. How many shares am I going to buy? It's the most important decision I think you're going to make in the trade, right? And so I have a very simple formula that I use to position size based upon how much money I have in my account and what the volatility of the market is. To find out what the volatility of the market is, I use the 2 ATR. All right, so it's two simple things. Let's just say I have $100,000. I simply take 1% of the $100,000 as my maximum allowed loss on the trade. Some people use 2%, some people use 3%. I like 1%. Okay, so if I have $100,000 times 1%, that's my maximum allowed loss, $1,000, and I simply divide it by the value of the 2 ATR divided by 2.15 tells me, based upon the volatility of the market and my maximum allowed loss of 1% of my total trading account, that I should buy 465 shares. Okay. If the volatility was higher, I would buy fewer shares. If the volatility was lower, it would have me buy my shares. So it's just a good formula that will always keep you in sync with what the volatility of the market is and what my maximum allowed loss is. So on this particular trade, 465 shares. Now, the very first thing that I do once I entered here at 23.88, I simply take my entry price minus the 2 ATR, which we just did the math on, and I place it $2.15 below. And if I have 465 shares and it moves down $2.15, there's my $1,000 loss. That's my 1% loss of my account. Not fun to lose 1% of your account, but it's manageable. You can recover from this. But the good news is that only happens, I only hit my emergency stop about 5% of the time. The other 95% of the time, if I have a loss, it's not going to be because I hit my emergency stop. That happens very infrequently. The other 95% of the time will be if I have a close below my end of bar stop. So I always use two stops, emergency stop and an end of bar stop. On this particular trade, I entered it because it rejected the bottom of the order block. And now in the future, if I get a close below the bottom of this order block, I'm simply going to get out for a much smaller loss than my emergency stop, or most times, right? It could end up down here and it would still be a big loss, but I always try to enter as close to my entry price as possible. Okay, so I bought with a rejection at the bottom of the order block, 23.88. I position size based upon the 2 ATR value and my maximum allowed loss. I placed my maximum allowed loss area here. My end of bar stop is a close below the low of this order block. The next thing I do is I take my entry price and I look for the value of the 1.5 ATR. The value of the 1.5 ATR at this moment is $1.61. I take my entry price plus whatever that value is. Right now it's $1.61, and I place it above my entry. This is my trailing stop mode. You know, in trading, when you enter a trade and it moves a certain amount from your entry, for me, I use the 1.5 ATR, that's a pretty significant move. And once it gets up there, I don't want to give it all back. So once I get 1.5 ATRs from my entry, I go into what is called trailing stop mode. And trailing stop mode just means if I get to 1.5 ATR, now if I have a close below a previous bar's low, I'm going to get out of half. And by getting out of half of my position, that has the effect of moving all my stops up. You probably heard, well, when you go into trailing stop mode, you move your stop up. I don't move my stops anywhere, but by taking off half of the position, it has the same effect of moving the stop up. All right. So, all that means is if I get to trailing stop mode and then I have a close below previous bar's low, I'm going to exit half. So everything I've talked about so far, as far as the emergency stop, the end of bar stop, going into trailing stop mode, these are all defensive moves. So in other words, if the market moves against me, I have to take action when something's not going my way. That's defensive. But I also like to play offense in my trading, just like in sports. You need to play offense and defense. Well, in trading, it's a sport. I also need to play offense. And the way that I play offense is I take a partial profit each day if the price moves a certain distance from the previous bar's close. So I'm going to show you, I'm in this trade at the moment. I'll show you exactly what I'm going to do for Monday. It's very simple. I just take the closing price of the day. Right now, the closing price of the day is $27.41. And I look now to the value of the 0.45 ATR. The value of the 0.45 ATR is 48 cents. I simply add those together. The closing price plus the value of the 0.45 ATR plus 48 cents. My first profit target for Monday is 27. That's 89, right? 27.89. So how much do I sell at this profit target? 10% of however many shares I go into the day with. If I go into the day with 100 shares and it gets to my first profit target, I'm simply going to sell 10 shares. Now I place 3 profit targets every day and I would sell the same amount, 10% at each level. So if I have 100 shares, 10, 10, and 10. So the first profit target, closing price plus the value of the 0.45 ATR, first profit target, 27.89. I'm going to add again the value of the 0.45 to it, plus 0.48. Second profit target for Monday, 28.37. And I'm going to do it one more time. Take the second profit target, 28.37 plus 48 cents. My third profit target for Monday, 28.85. And again, however many shares I go into the day with, I'm going to take 10% off at all 3 profit targets. So if I go into the market, or if I go into Monday with 100 shares, I would sell 10 here, sell 10 here, sell 10 here. If it goes down, I don't hit any profit targets. I have to redo it from the next day's previous close. But if I have a little decent day up, okay, I hit 1. If I have a really good day, I hit 2. If I have a great day, I hit 3. And one of the advantages of taking these partial profits, there's different advantages, but to me, one of the most important is I'm selling into strength. When the market's giving me something, I'm taking something. The other benefit is that it continues to reduce your position size. And the more of your position that you take off, the smaller your position size, obviously, but the smaller your position size, the more likely you are to follow your rules. So I think there's a huge benefit from that. So, okay, kind of covered the basics. So let's just quickly then go over the trade again. Why did I enter the trade here on 519 at 23.88? Because it rejected the bottom of the order block. I position size, I placed my emergency stop 2 ATRs below. My end of bar stop is a close below the low of the order block. I placed my 1.5 ATR trailing stop level above, and the next day opened up, went down, but reversed back up. I hit multiple profit targets into this day. So already I'm starting to reduce my position size. I also got to trailing stop mode the very next day. So now it doesn't mean I do anything. It just means now in the future, if I have a close below previous bar's low, I'm going to get out of half. Next day, up a little, not enough for a profit target. Next day, down a little, but didn't close below the previous bar's low, so I do nothing. Next day, up nicely, profit targets into that day. Next day, again, up very nicely, multiple profit targets into that strength. And we have a couple days sideways, doesn't do much. Here on the first, we have our first close below a previous bar's low. What do? I take off half of the remaining shares that I have. And so I locked in half the position for a gain of 13.05%. And over the next 4 days really didn't do anything. Here from the third to the fourth, did hit a profit target on that strength, no profit targets today. So I locked in half for a gain of 13.05%, and the remaining shares that I have at this point up 12.86%. All right, next trade. This one has been all over the place, but definitely has not got to my stop yet, so I'm staying into the trade. But this was an interesting trade that I took. I've been in this trade for actually quite a while. This is silver, which had a very bad day today. But I did enter silver back here on the 18th of February at 69.80 for a couple reasons. The first reason was, you can see the green box, that's the order block. The previous day we closed in the order block. The next day we closed above the order block. That's a rejection of the order block. Okay, that's a signal. In addition to that, you can see this bar here I've highlighted in blue. This is what's called an abandoned baby. An abandoned baby happens when you have a gap down followed immediately by a gap up. When this happens, more times than not, that's going to indicate higher pricing. So the confluence, the combination of signals on this trade was twofold. We closed in the order block, closed above the order block, rejection of the order block, and we created a abandoned baby. Now, when I trade abandoned babies or island reversals, um, this is the one exception where I don't do trailing stop mode. I don't take partial profits. Occasionally with some of my trades, I like to just have a one or the other trade. Or in other words, I'm going to risk this much to make this much, and I'm just going to let it go. And so with abandoned babies and island reversals, these are the trades that I choose to do that. Last week, I had one of these trades on UNG. It was a fantastic trade. Well, I guess I should show you the risk to reward. So after I took the entry, I 1% of my account divided by the 2 ATR, that's my emergency stop. This is the red line. So if I, when I enter here, if it gets down here, it's just like hitting an emergency stop. I lost 1% of my account. But to the upside, instead of a 2 ATR stop, like for the emergency stop, I place a 4 ATR profit target. So on this particular trade, I'm risking 1% to make 2%, and I just let it go. In the future, obviously, eventually, I'm either going to hit this stop for a loss of 1%, or I'm going to hit this profit target for a gain of 2%. Last week on the UNG trade, exactly the same trade, pretty much exactly the same setup, I did hit the 4 ATR profit target, or the 2%. So I risked 1% to make 2%. I made 2%. So on this particular trade, that's why I entered here, 69.80, emergency stop 2 ATRs below, profit target 4 ATRs above. The trade started off great, really started great, but silver's been all over the place. Moved sideways, moved down. Remember, I'm not taking any partials. I'm not doing anything. This is a one or the other trade. Then we started a nice move up again, got positive in the trade, then down, and then up again. Really started to be good. And then, of course, over the last few weeks, silver has just gone down. So this was my entry point, 69.80. This is my emergency stop down here. Remember, even if it comes all the way down here, I only lose 1% of my account. So this trade is down pretty good. It's down 13.56%. But again, does that mean I'm down 13.56% on the trade? No, I am not. I'm down about 0.5% on the trade. So I'm just going to let this one go. That's the reason I create this type of trade, just so I don't have to do much with it. But if next week it does come down to that emergency stop, I will lose 1% of my account. But again, as far as entry to current price, this is down 13.56%. LMT. All right, well, in LMT, you see that there's a green box. That means an order block from the past. So I waited for Lockheed Martin. You can see Lockheed Martin really had a sell-off, but once it started to get down into this order block, that's when I got interested in buying. And I did buy LMT here on the 11th of May, about 509.90. And you might look at this and go, Greg, it didn't reject the high of the order block. It didn't reject the low of the order block. That is true. But this purple line here is a 250-day moving average. This is a key moving average. This is where large financial institutions and savvy traders key off of. So the important concept here is we had a rejection of a key level, the 250-day moving average. The previous day we closed below it, and then we closed above it. That's a rejection of a key level. But the rejection of the key level, the 250, came inside a key area, a key level of the order block. So that's the confluence of the trade. I love buying rejections of the major moving average inside of order blocks, or in other words, in smart money areas. So I did buy here on the 11th at 509. I position sized. I placed my emergency stop 2 ATRs below, as always. My end of bar stop is simply a close below the 250-day moving average. I'm very close to that to begin with, so it's a good risk to reward ratio. I place my trailing stop level 1.5 ATRs above, and let's see what happens with the trade. Next day, moved up right away. Perfect. Hit a profit target. Next day, down a little, nothing. Next day, down a little. Next day, down. This day here on the 18th, big up move. and also took partial profits into that strength, right? I always take partial profits into strength on the upside. Then we move down, we move up, hit a profit target on this day, hit a profit target the next day, little move down, and then here on the 28th, we had a big move up where I sold into that strength, and I also got to trailing stop mode. Now, just because I get to trailing stop mode doesn't mean I take any action. It just means now in the future, if I have a close below previous bar's low, I'm going to exit half. And this is what happened the very next day. We got our first close below previous bar's low. After reaching trailing stop level, I took off half of the position that I had remaining for a gain of 3.57%. And again, taking off that half has the effect of moving all of my stops up, which is proper trading. Then from there, we moved down, we got close to the 250-day moving average. Had it closed below here, I would have had to get out of the trade, but it did not. Next day, we had a big, strong up move where I did sell into that strength before it reversed back down. We continued to hold the 250-day. Next day was up for a profit target. And again today, moved up, and I took a profit target near the high of the day. So I did exit half for a gain of 3.57%, and the remaining shares that I have at the moment are up 2.86%. All right, Dash. Okay, so Dash I entered on 5/14 at 153.70. You can see it's in an order block. Now, it didn't reject the bottom of the order block. It didn't reject the high of the order block, nor did it have a major moving average inside the order block. But I placed my own level here at 151.40 based upon something that happened in the past. So if we go back to the past, I want you to take a look at these three bars. These three bars, this formation is called the V2 entry signal. And a V2 happens with three bars, bar 1, bar 2. The rule is bar 2 has to go under bar 1's low, which it did. And then bar 3 has to close above bar 1's close, which it did. Very good entry signals. And you can see this V2 did lead to this move up. But the key point of a V2 is the number 2 bar. We call this the washout bar because it washes out or goes below bar 1's low. There's a key Fibonacci level on a V2, and it's halfway of the number 2 bar, or in other words, halfway of the washout bar. So the low of the bar, the high of the bar, you can see I put the line here at 151.40, halfway of the washout bar. This is a key level of support. So we had the swing low, swing high, lower swing low, market structure change, define the order block, and then I put this key level in here. If in the future it were to come back here and reject this level, I would enter the trade. So it did come down, but on this day it closed below it, so it did not reject the order block. But the very next day it did reject, not the order block, but the key level in the order block. It closed below that key level. The next day it closed above that key level, and that was my entry. So I entered here 153.70. I position size based upon the volatility in my account size. I placed my emergency stop 2 ATRs below, as always, and my end of bar stop is simply a close below this 154 level. And again, I entered very close to it, so it's a very good risk to reward ratio. Place my trailing stop level 1.5 ATRs above. The next day, good start to the trade, hit a profit target, moved my way. Next day, up again for a profit target. Next day, but not to trailing stop level yet. Next day, down. Next day, that was scary, was way down, reversed all the way back up, actually ended up with a profit target on that day. Next day, nothing. Next day, up, took a profit target near the high and got to trailing stop mode. Once I get to trailing stop mode in the future, if I have a close below previous bar's low, I'm going to get out of half. Well, it's exactly what happened the next day. Had a close below the previous bar's low. After reaching trailing stop level, what did I do? I had to sell half of my position, essentially for a small gain, 0.185, or sorry, 0.18%. Remember, my key level is this 150, 140. So the remaining shares I kept. Next day moved up, profit target. Next day, nothing. Next day moved up, profit target. Next day up again, profit target. And since then, we've gone down, we've gone down. You can see here on the 3rd, look at that. The low of the day was within pennies of that key level. So that's showing me that that key level was being respected. Next day, Thursday, nice big up day where I sold into that strength. And then, of course, today was down. So the remaining shares that I have on this particular position up 2.01%. But you can see, even if this trade does come down and close below my key level of 150, 140, you can see the advantage of taking partial profits when the market gives them to you. And if the trade does reverse, you have fewer shares. So now you won on two fronts. You sold at higher levels and you have fewer shares, which would help mitigate the loss to the downside. All right, so the remaining shares up 2.01%. All right, ET, energy transfer. Well, you see we have a green box. This is an order block. And this particular trade, you can see the gray line, which is the 50-day moving average, moving inside the order block. I did enter the trade here on the 1st of June at 1927 because the previous day we closed under the 50, and the day that I entered the trade, we closed above the 50. So I position sized. I placed my emergency stop 2 ATRs below as always. My end of bar stop is simply going to be a close below the 50-day moving average. I'm almost at the 50-day moving average at entry. So again, a good risk to reward ratio. Next day, moved up, great. Hit some profits into that move up. The next day, moved up near the high. I hit another profit target. Next day was up a little bit. Today was down, but we have not reached trailing stop level. So a close below previous bar's low does not count, or I don't have to take any action. So we move back down today. We are still above the 50-day. Monday or next week, if it closes under that 50, I'll just get out of the trade. That's all. You just have to follow the rules. So slightly positive on this trade, not a lot, but slightly. And at the moment, this trade is up 0.57%. All right, UNP was a really good trade. You know, recently I had a scanner developed, which is really interesting. And I had it customized, and it's great having a scanner, but when you have a new program, you know, there's always bugs. So I've kind of been dealing with this for a couple weeks, but I'm grateful that the scanner picked up this trade because I would not have found this trade without it. So far, really good. This is UNP, Union Pacific. I did enter Union Pacific on Thursday at 263.90. Why? Well, let me bring your attention to this green line and this green line. This green line is called the 1 ATR channel. The bottom green line is called the negative 1 ATR channel or Keltner channel. Anywhere beneath this green line and above this green line is called the value zone, and it's an interesting area. So the reason that I bought this on Thursday was because we were below the value zone. We rallied into the value zone, and then we had a pullback with the V1 entry. You heard me a little while ago talk about V2 entries. V2 entries consist of 3 bars. A V1 consists of 2 bars. And it's very simple. Bar 1, bar 2. Bar 2 goes under bar 1's low, but then closes above bar 1's close. And by the way, if you want to learn more about V1s, V2s, I have a YouTube video on my channel. Just look up V1s, V2s, and I go into detail about all the rules and so forth. But really, the reason I entered this trade is because we were below the value zone. We rallied into the value zone. We had a pullback and reversal back up where I entered at 263.90. So I entered 263.90. Position size, place my end of bar stop. Now, on a V1 or a V2, the close is always a halfway below the washout bar. Well, you can see on my entry, it is exactly at halfway. So this is about the best risk to reward ratio I could have. So when I entered this at 63.90 today, if it had even closed a penny below my entry, that's my end of our stop. So it's a very, very good risk to reward ratio. Fortunately, um, moved up very nicely, hit multiple profit targets on the first day of the trade, and also got to trailing stop mode. So again, I'm in trailing stop mode, but the only time I'm going to take any action is in the future if I have a close below a previous bar's low. And we only have the 1 day, but very good trade, very good start to the trade. And this particular trade at the moment is up 3.1%. All right, so those are all the open trades that I still have and that I'm still managing. Let's go to the closed trades that I took last week and I had to get out of. This is Costco. I did buy Costco back here on the 29th of May at 9:56.26. A little hard to see that. Apologize. But on this particular day, we bounced, we rejected the high of the order block, and we closed above the 200-day moving average. So I entered emergency stop 2 ATRs below. My end of bar stop was simply a close below the 200, and I entered so close to the 200. Then I placed my 1.5 ATR trailing stop level above. The very next day, right away it closed below the 200. I had to get out of the trade. So losing trade, yes, but 1.08%. But the key here is that, look, I waited for rejection of multiple levels, rejection of the 200, rejection of the top of the order block. I position sized. I did everything I could possibly do, started the trade with a good risk to reward ratio, and it just didn't work. I just had to get out of the trade, and I did. But listen, in trading, small losses are completely acceptable. You're going to have them all the time, and just be grateful that you're small. So, was I grateful to have a loss? Well, I wasn't thrilled about it, but it was a small loss. And did it take right back up after I got out? It did. But that happens in trading. All right. So, anyway, had to lock in a 1.08% loss on Costco. NEE, another example of I entered NEE. Oh, we have a dividend. I entered NEE here at 80, uh, essentially 85.48. Lots of confluences on this signal. The previous day we closed below the 200. The day I entered, we closed above the 200. The previous day we were closed below 30, closed back above 30. That is a key setup, everybody, and also rejected the order block. So I took the trade. My end of bar stop closed below the 200-day moving average. The very next day, it closed below. These lines are off a little bit because today we had a dividend, so it moved everything. But this particular trade is definitely from here to here as far as percentage, and I did lose 1.08% on the trade. Next day, re-signaled. I did not get into the entry, and this moved up again today. But one of my students, Vivek, got back in, so congratulations, Vivek. So this was a losing trade. Again, really good signal, just didn't work. But let me give you some advice. When you have a losing trade, get out quickly. When you have a winning trade, have yourself a process that keeps you in the trade. And so I'm very impatient with my losers, and I'm very patient with the winners. And as soon as I entered, it closed below my stop. I had to get out, booked a 1.08% loss. Gold, oh my gosh. Yeah, it was not a good trade. Really glad that I did take some profits when I had them. So on gold, I did enter gold here on the 27th of May at $408.48. You can see this happened inside an order block. But you might ask, Greg, there's no moving averages. Why did you take the trade? It's based upon what is called the megaphone trend line. Megaphone trend line is when you have a swing low, and then in the future you have a lower swing low. And I connect this swing low with this swing low, and this trend line goes out into the future. So this is touch 1, this is touch 2. Generally, when you get the third touch on a megaphone trend line, you tend to bounce. Now, I'm not going to just take a trade based upon a rejection of a trend line, but because it happened inside the order block, that's why I took the trade. So I got in at 408.40, at 408.48, placed my emergency stop 2 ATRs below. My end of bar stop is a close below this trend line, and I placed my 1.5 ATR trailing stop level above. Next day, moved up in my direction, thankfully. Why thankfully? Because look where it is now. So I did book some profits on part of my trade and reduced my position size. The next day, up again. Thankfully, I reduced my overall position size and locked in some gain. The very next day, we have a close below the previous bar's low. After reaching trailing stop level, what do? I took off half of all the shares that I had for a gain of 0.7%. Not a huge gain, but more importantly, because of what happened today, I reduced my position size even further. So I take profits here, reduce position size. Take profits here, reduce position size. Trailing stop mode tells me to get out of half of everything. Then we move down. Next day sideways, next day down. Yesterday was an up day, which again, thankfully, I took advantage of that and reduced my position size, hit a profit target before today. Clearly, I had to get out of the trade today. The remaining shares for a loss of 3.11%. You can see I almost got to trailing stop mode. Only happens about 5% of the time, but today was such a big down day on gold that I almost got there. Didn't get there. But the key, this is just such a perfect example of why it is important, for me at least, to take partial profits when I have them and going into trailing stop mode and selling half, because this completely mitigated a large percentage of this loss by having these rules. So like I said, in sports, you have to play offense and defense, and trading really is a sport to me. And this shows you, this is an example, shows you why it's so important, for me at least, to take partial profits when I have them. So the remaining shares down 3.11%. GDX, also a losing trade, but shows the importance when you lose a level of getting out. I took GDX here on the 21st of May at 86.10 order block. On this particular day, not only did we intraday reject the 200-day moving average, we also rejected the bottom of the order block. So I entered here 86.10, position size correctly, placed my emergency stop 2 ATRs below as always. My end of bar stop is a close below the 200-day moving average. Place my trailing stop level 1.5 ATRs above. Next day down a little, but barely held on to that 200, kept me in the trade. The next day, big move up, sold into that strength, thankfully, sold into that strength. Next, and took profit targets. Next day, down, but held the 200-day moving average. The next day opened up ugly, but again, at the close, closed back above the 200-day moving average, also hit a profit target. Next day, up again, sold into that strength. Have not got to trailing stop level. Next day, down, but held the 200. Next day, up, profit target. Here on Wednesday, closed below the 200-day moving average. What do I have to do? I had to get out of the trade. And I did get out of the trade for a loss of 1.36%. Next day moved up, and I was like, well, I got stopped out, moved up. But then today, of course, with all the mayhem that happened in the market, this was down huge. Yeah, down huge. So, in hindsight, I'm glad I stuck to my rules, took the small loss. And, when we lose, the reason I get out when we close below these 200s these are key levels. If the stock is not strong enough to close above it, I don't want to be in it when it's resistance above me. So glad that I followed the rules, and then also glad, as always, when there are reversals in my trades, that I did take partial profits and sell into that strength, which reduced my overall loss on the trade. So this lost 1.36%. RBLX. All right, interesting trade. So I got into RBLX here on the 15th of May at 42.85. The actual entry was the previous day. And the reason why is the day before that, we closed below the 30 RSI. The very next day on the 14th, we closed above the 30 RSI. So that's a under 30 over 30. That is a deep dip buy entry signal. Now, I didn't take it on this day because I took another position, but the next day, had I taken it the previous day and then the next day was down, I would still be in the trade. So the way that I look at this is if I miss a trade and the next day it's down, but it's still holding its levels, to me, it's still legitimate to get in. I'm just getting a better entry. And so that's exactly what I did. I got in at 42.85. My end of bar stop is a close below the 30 RSI because that's essentially why I took it. Close under, close over the 30 RSI. So my end of bar stop is a close below the 30 RSI. Have my emergency stop 2 ATRs below, place my trailing stop level 1.5 ATRs above, and then the next day took off like a rocket ship. Sold into that strength, of course, took advantage of that big move up. Next day down. Then the next 3 days we kind of move ourselves up. And then here on this day, on the 22nd, not only did I hit a profit target, but I also got to trailing stop level. The very next day, we closed below a previous bar's low after reaching trailing stop level. What do? I sold half of my position for a gain of 6.78%. Then we move sideways, and we started to come down. So here, I exited the position exactly at my entry point. So I have a rule that I use and I teach my students. If I take a trade with an under 30 over 30, and then I get to trailing stop level, only in the case of an under 30 over 30 is if I get to trailing stop level and it comes back to my entry point, I exit the trade at break even. Right? Because if you go under 30 over 30 and you move all the way up to your 1.58 your trailing stop level and come back, I don't want to let that nice, really good trade turn into a loss. So that's exactly what I did. On the 3rd, I got out at break even on the balance of the remaining shares. But overall, was a profitable trade. You can see the next couple of days were down, so really glad that I took that. But again, it just goes to show you, in my opinion, how important taking partial profits is and why I go into trailing stop mode. This was a profitable trade for me because I took advantage of the moves up, have the rule of selling half up here, which was at a profitable level, right? So all in all, great trade, really. And had I not taken profits, done anything, this great trade would now be a losing trade. So the remaining shares there I got out on the 3rd at break even. And Netflix. Netflix again was one of these losing trades, a very small losing trade, but in hindsight, very glad that I followed my rules. You can see I took the trade here on Netflix 528 at 86.40. Why? Well, here's an order block. Swing low, swing high, lower swing low, market structure change, defines the order block. Now, again, no moving averages inside the order block, but I made my own level inside the order block. Why? It comes back to these 3 bars, bar 1, bar 2, bar 3. 2 goes under bar 1's low, 3 closes above bar 1's close. That's a V2. Where's the key support level on a V2? Halfway the washout bar, 86. Brought that in on the day that I entered at 86.40. The reason I did it was because it rejected the 86, closed above it. Okay, it showed me it didn't like there were not sellers, at least at the moment, below it. So I entered 86.40, placed my emergency stop 2 ATRs below. My end of bar stop is simply a close below $86. Placed my 1.5 ATR trailing stop level above. Next day was down, but barely closed above 86, kept me in the trade. Next day, closed below 86, closed below my key level. What did I have to do? I had to get out. Was it a loss? It was, but it was a small one, right? You can have a lot of small losses in trading. If you're a good trader, you'll have a lot of losses. If you're, I mean, as a trader, you'll have a lot of losses. As a good trader, you'll have a lot of losses, but they'll be small losses, and that's the key. And yes, I did lose 0.65% on the trade. But the bigger story here is I got out before all of this carnage. It's never fun to take a stop loss, but when you take it and then it continues down, makes things a little better, right? So I did get out for a loss of 0.66%. Okay, so those are all the closing trades. Closed a lot of trades this week, because of the market volatility. I do have one weekly trade that I'm still in. It's McDonald's. This is on a weekly time frame. Have an order block. Again, weekly bars. Have an order block, and kind of my favorite setup. Nice 200 or 250 or 300 day or 300 week, in this case, inside the order block. So I entered McDonald's here. The dividend, so it changed everything around essentially. But I entered McDonald's here at 276.39 because of rejection of the order, the 250 week order block. 250 SMA inside the order block. Place my emergency stop 2 ATRs below. End of bar stop, simply a close below the 200 week moving average. Place my trailing stop level 1.5 ATRs above. Next move up, or next week moved up, hit a profit target. Next week down. This week, earlier in the week, was below the 200 week moving average. Had it closed here, I would have had to gotten out of the trade, but it rallied, closed back above, kept me in the trade. So the current position that I have left is up 1.22%, and I also got a dividend of $1.86. So not too bad. So up 1.22% on the actual trade itself, plus throw in another $1.86 as a dividend. So pretty good. So going forward, if it continues to move up, I will continue to hit profit targets. If I get to trailing stop mode, I go into trailing stop mode. If next week it closes below the 200 week moving average, I get out. Worst case scenario, have my emergency stop down here, and I already know if I get down there, I already know how much I've lost because I did the math before I got in the trade at 1%. So anyway, glad to see McDonald's is up. I know, tough week. I talked to a lot of traders today. They're having had a tough day, kind of a painful day. A lot of them were, levered up on technology stocks way up there, and yeah, I feel for you. I feel for you. I didn't have any technology stocks because they're so high that they're in an area that I just don't buy. I like to buy things on sale. I like to buy things in order blocks near major moving averages. But sometimes I miss out on those big moves that way. So there's always pluses and minuses. All right, so listen, before we take a look at next week's trades, just want to talk a little bit about trader psychology. This week's post is from Thomas Payne. I know Thomas. You can follow him at Trader T Payne. What I like about Thomas is Thomas, before he became a trader, was a scientist. And, as a scientist, you use a scientific method, checklists, and if-then statements, and so forth. And he brought his scientific background into trading and applied his science-based thinking into trading, into a process, which I think is fantastic. And that's why he's a good trader. So let's see what Thomas has to say. We all trade the same stocks using the same tools while looking at the same charts. All of the appropriate rules and strategies are very well-known information. Everybody can read the books. The difference is how we process it and apply it. That part is in your head. This is so true. Listen, major moving averages are not a secret to anyone. Order blocks. Fewer people know about order blocks, but people know about them. RSI levels. All these things that I use and I teach to my students is not proprietary information. It's like Thomas said, they are very well-known information. So why are some traders profitable and why are some traders not profitable when we all know this information? Everybody, it comes down to what Thomas says. The difference is how we process and apply it. We all know how to make money in trading. Position size, good risk to reward ratio, let your profits run, cut your losers short. Some people actually do that and follow the rules, and that makes them profitable traders. Other people think the rules don't apply to them. They like to theorize and have predictions about where the market's going to go. I don't theorize or predict at all. I let the charts tell me everything. Did it reject this level? Okay, I'm in. Did it close below this level? I'm out. My best advice to all of you, get yourself a process and follow it with laser beam focus, regardless of what your emotions are telling you. And that's why Thomas says that part is in your head. The difference is how we process it and apply it. There's a lot of good trading processes and strategies out there, step by step, but you have to follow it. And that's the trader psychology part. So thank you very much, Thomas. Please follow Thomas at Trader T-Pain. All right, everybody, let's get to the trades for next week. I have 9 potentials for next week. A lot of these symbols I never talk about because they've always been so high, but now we're getting, with this pullback, some of them are kind of coming onto my radar. So I discuss this every weekend on the podcast. So look, I have 9 potential symbols for next week. Theoretically, Monday, all 9 of them could trigger. Does that mean I would take all 9 trades? No, it does not. I only take 1 trade per day. Even if I have 10 super trades, I'm going to have to find the one that's better than the other 9. And I do that by giving a scorecard to every setup. If it has 1 signal, maybe I give it 1 point. If it has 2 signals, I give it 2 points. One has 3, I give it 3 points. But that's not all there is to it. It's not just the highest number. I have to look at the risk to reward ratio. Maybe it has 4 entry signals, but has a horrible risk to reward. I have to deduct points for that, right? I also look at larger time frames. If I'm trading the daily, I like to look to the weekly, see if I can get some clues there. I also look at the relative strength of the stock compared to the rest of the market. If the market's down, but one particular entry, the market's up, well, I give that an extra bonus point because it has relative strength. Had the market been up that day, it probably would have been up more. So this is how I trade. This is what I teach my students. And if I could just put in a quick little plug for myself, I do teach students all over the world. I teach a 20-hour one-on-one course. I think one-on-one is the best way for any student to learn anything with their teacher. It's 20 hours. We spend 2 hours a week together, and we do it for 10 weeks. I teach you all of my strategies, all of my rules. We do a lot of simulation trades. I ask a lot of questions, and it's very important to me that my students succeed in trading. Extremely important. I want every one of my students to succeed. And so I always give all my lessons that I teach 110%. And so if you are interested in learning to trade like I do, I've traded for over 30 years. I've been through lots of different markets, and I have very good uh, uh, trading approaches and processes that I will teach you. So if you're interested, like I said, it's 2 hours a week for 10 weeks. We'll get to know each other very well. We'll see a lot of different things in the market. But if you're interested, just send me an email. My email is in the link of this YouTube video. And I always like to say this, if you send me a video or if you send me an email and say, Greg, interested in taking your course, I'll reply and say, hey, great, perfect. Let's set up a call, kind of get to know each other. But it's not a sales call at all. It's not a sales call. I just want to learn more about you, your trading goals, your trading challenges. It's also a really good time for you to ask me any questions about the format of the course. And then when we're done with the course, done with the call, that's it. If you want to write me back and say, Greg, I want to take the trade, do it. Perfect. So I'd love to have you as a student. I will give it all my best, and I'll teach you everything I know. Now, in addition to the one-on-one course, I also have a video course at udemy.com that people from all over the world have bought that course. And in that course, I teach you the deep dip buy stock trading strategy. It's 9.5 hours of video. It's a very affordable course. It's between $30 and $50 at udemy.com. And it is a great course. So the one-on-one course, 20 hours, you and I together for 10 weeks. That one's $2,000, but I promise you it's worth every penny. It's an investment in a skill that you can use the rest of your life, or the Udemy course, which is the video course. So anyway, thank you for letting me put in my plug for the day, and let's get on to what I'm looking at for Amazon. So first on deck is Amazon. Amazon was down a lot today because of the markets. So, this is a strategy that I don't talk a lot about, doesn't happen a lot. If you've been listening to this podcast for a while, you will probably remember. But let me bring you the attention to this 200-day moving average, the black line, and then the gray line. The gray line is the 50-day moving average crossing over the 200-day moving average. When this happens, that is called the golden cross. This is a long-term crossover strategy. But what I have noticed, seems like every single time, everyone says, oh, ooh, the 50 crossed over the 200. That's long-term bullish. Yeah, maybe long-term. But what I notice is whenever that crosses over, the market goes down. Right there, crosses over, yay. It's the golden cross. Well, like I said, what happened? It went down. But one thing I have noticed over the years is when you have a 50 crossing over the 200-day moving average, the first time that the price gets back to the 200 after crossing over the 50 crossing over the 200, the first time the price gets back to the 200, usually get a reaction, a bullish reaction. So what I'm looking for next week is a rejection of this 200-day moving average. There's not an order block. It's just simply that we had a golden cross. And I know from experience that more times than not, after you have the golden cross and you have the first pullback to the 200 and rejects, you tend to get a bullish reaction. So I'm simply very simple. I'm just simply looking for a rejection of the 200. That could be a close under, close over. That could be a bounce or an intraday rejection at the 200. And, the 200's at 232.13. We're at 246.03. I don't know if it's going to get there. I don't know. I don't care. But if it does, I will consider taking the trade. Cameco, CCJ. Well, we are almost right there. You can see in this green box, this is an order block. What lives inside the order block? The 200-day moving average. It did not reject the 200-day moving average today. Next week, however, if it does, I will certainly consider taking the trade. Next week, if it bounces the 200, closes under, closes over, or intraday rejects the 200, I will consider taking the trade depending on the risk to reward ratio. And then, of course, my stop would, moving forward, would just be a close below the 200. So the 200 right now is 101.64. We're at 103.44. We're certainly within striking distance, but we'll see if we get a reaction at that 200. And if we do, I will consider taking the trade. Again, my stop will be a close back below the 200. CRM, Salesforce. All right. This is one of those examples where we have a recent order block, swing low, swing high, lower swing low, market structure change, defines the order block, lowest closing bar, bring it into the future. There are two levels right away that I'm looking at. The first is the 50-day moving average. The 50 is at 181.22. 181.22. Next week, if we were to come down and reject that 50, I would consider taking the trade there because it's a rejection of a moving average inside an order block. If it does reject the 50 and I take it, my end of bar stop would simply be a close back below the 50. In addition to that, I have another level that I placed here myself at 175.80. Why? Refer back to the V2, bar 1, bar 2, bar 3. 2 goes under bar 1's low, 3 closes above bar 1's close. I know that halfway of the second bar will be inherent support at 175.80. So I'll use that as potential level. So I'm looking at two levels. Potentially, first, a rejection of the 50, which is 180, 120, or a rejection of 175.80. And for example, if I take the 175.80, rejects it, and I take the trade, then my stop would just simply be a close back below 175.80. Russell 2000, boy, I have not talked about any potential entries on any indexes for such a long time. But with today's huge move down, we're getting, at least there's one there. You see the order block that was created. Why? Swing low, swing high, lower swing low. Market structure change defines the order block, lowest closing bar before market structure change. Bring it into the future. And what lives inside the order block? The 50-day moving average. Well, to be precise, I didn't notice this, but there's also another level right here. Again, V2. Bar 1, 2, 3. Halfway of bar 2 is going to be the inherent support. So two levels here. The first one would be a potential rejection of the 50-day moving average, 274.12. The second one, rejection of the halfway of the V2 bar here at 272.60. Now, look, we may never get there. And if it never gets there, I'm just not going to take the trade. I will eventually find something that gets to where I want it to get to. But if this down move continues, then I have a couple levels. Nike. All right, Nike's getting very close. You can see Nike did bounce from the bottom, came back into this order block, had this huge move up, but today, or last week, Nike came down pretty significantly. So there is a key. We're back in the order block. No moving averages, but there is a key level here at 42.57. But Greg, I don't see a V1 or a V2. That's correct. But what you see here on the 20th is a big old up bar. Why is that important? Whenever you have a big up bar, larger than 1 ATR, if you get to halfway of that big up bar, there's generally support there. And you can see that's why I put the 42.57 level here. It's halfway of this big bar on the 20th. So next week, we're very close to this. If next week we reject that 42.57 level, I will consider taking the trade, and then my end of bar stop will be a close below 42.57. But this big up bar here, this was a big up bar for a reason. So coming back down to halfway of that is very appealing to me. One, because it's halfway of this big up bar, and two, because it's inside this order block. But that level that I'm looking for again is rejection of 42.57. The Qs. I can't believe I'm actually highlighting the Qs. Well, listen, we have an order block here. Swing low, swing high, lower swing low, market structure change. Up here, everybody said the market would never go down again, ever. There were a lot of warning flags, to be honest with you. Double top bearish MACD divergences, ATR divergences, RSI divergences that were waving red flags that potentially this could happen. And it happened today. But this is the level that I'm looking at, the $700.27 level. Why? Again, it's a halfway of these three bars, V2, inside an order block. So I'm going to be watching this one closely on the Qs for a rejection of 720. If it does reject that, and I decide to take the trade, then my stop will be a close below $700.20. VIX. So of course, VIX had a big update today of 7.28%, and we changed market structure to an uptrend. Swing low, swing high, lower swing low, market structure change defines the order block. Now, I don't want to chase VIX on this kind of move up. However, the last three bars created a V2. Bar 1, 2, 3. 2 goes under bar 1's low. 3 closes above bar 1's close. Where's going to be the inherent support? Halfway. of the number 2 bar, 23.95. Now, this is important, everybody. VIX has changed market structure to the upside. What does that mean for equities? Well, that probably means equities are more likely to head down if VIX is going to head up. But after we break market structure, there's generally, it doesn't happen all the time, but it happens frequently, where after you break market structure, then you have a pullback. If VIX has a pullback, what happens to the market? Market goes up. But if VIX comes back down, meaning the market goes up, and we reject this 230 at 23.95 level, that more than likely to me would indicate that VIX would move up higher and the market would move lower. So what I'm saying here, I wouldn't be surprised that we have a somewhat of a counter trend rally, a bounce in the market, which would move VIX down. But if I'm right, the move back up on the market will be short-lived. The move back down on VIX will be short-lived before it resumes its move up. So anyway, that's some prediction there. That's some experience of what I'm telling you. But again, I only go off the levels, and what I'm looking for on VIX would be a rejection of 23.95 to get long VIX if it comes back there, and only if it comes back. Verizon got trounced on Thursday. Look at this, horrible. So when you see something like this, big moves down, I have to look for a key level. So I've had a couple of these today. Don't usually talk about this, but let's look back here on the 30th, the January 30th, and see the big, huge explosion bar up on Verizon, VZ. Well, again, if we have big up bar, where's support going to be if we come back down? Halfway. Okay, there's your halfway. Let's bring the halfway into the future. Shoot. Do you see how the halfway of that previous big up bar is dovetailing with that 300-day moving average? That's the confluence that I would be looking for, about 42, 42, somewhere in there. Either a rejection of the 300 would be valid for me, or a rejection of the 42.30 level. So I don't know if it's going to get there. It may not, but if it does, I'm certainly going to look for a rejection. We'll just call it 42.30 or the 300, which is now 42.43. But that would be a key level. One, because it's a major moving average, and two, because it dovetails with the bar from way back in January, but these things hold in memory. So that's what I'm looking for on Verizon if it gets down there. And then last but not least is WES, Western Midstream. Again, we have an order block, swing low, swing high, swing low, market structure change defines the order block. Here's a V2. Halfway of the V2 is one of my levels at 41.73. No, excuse me, 41.69. There's also a level above it, which is the 50-day moving average, 42.38. And below both of those, there is a 100-day moving average. So there's three key levels inside this order block if we continue down. The 50, which right now is 42.38. My own level, the halfway of the V2 at 41.69. Or the 100-day moving average, which is 41.37. So, in trading, it's all about levels. Maybe it comes down, rejects the 50, I take the trade, closes below, I get out. Moves back down lower, rejects 41.69. Maybe that's the one that holds before it goes back up, or maybe I lose that one, and then the next level below. So I'm just going to work with the levels until I find one that actually works. So listen, appreciate you being here today. I hope you learned a lot. If you have any comments or questions, please put them in the comment section. I'll do my best to get back to you. If you could hit the thumbs up button, I would really appreciate that. Really helps keep the channel going and lets YouTube know there's some valuable content here. Have a baseball game tomorrow, fresh off my last game where I did get 3 RBIs and a hit. So grateful for that, and hopefully I can bring that into the game tomorrow. The thing is, I'm playing with 20-year-olds and 30-year-olds, and I'm almost 60. So I'm like the old guy out there. But, I'm just really glad and happy that at my age, I can go out and play with these youngsters. It's funny being around 20 and 30-year-olds. I'm not used to the language and the attitude. I feel like I'm the oldest person in the world when I'm on that team, but we have fun. And like I said, I'm just grateful that because I love baseball, I'm just grateful that I'm out there with those youngsters playing. So hopefully I'll get a hit tomorrow. Maybe a couple would be sweet. So I'll let you know. But I always like to leave off with please try to go out and do something nice if you, for another human being every day if you have the opportunity. Just make the world a lot better place. If you have an opportunity to uh, do an act of kindness for an animal, that'd be perfect. They appreciate acts of kindness just like we do. And, you know, we appreciate when someone does an act of kindness for us. So why not pay it forward? I know that's cliche, right? But, you know, go out of your way. Doesn't take that much. Make somebody's day better, make an animal's day better. So really appreciate you being here, everybody. Really do. And God willing, I'll see you next week. But next week, please be careful. The market's very volatile. And get yourself a process and follow the rules. It's my best advice. Thanks a lot, everybody. Take care. Thanks for listening. Bye-bye.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.